I'm Bobby Wrinkle, Adult Programming Coordinator, and welcome to 101 Series. Whether your goal is to send your kids to college or retire on a yacht in the Mediterranean, wouldn't that be nice? Investing is essential to getting where you want to be. Our speaker tonight is a graduate of Murray State University, majoring in economics. He's actively involved in Paducah Young Professional and is a member of the Downtown Kiwanis Club. He currently serves as financial consultant at Hilliard and Lyons. Let's welcome Cullen Pope as he presents Investing 101. Cullen.
Thank you, Bobby. Good evening, and thank you, everybody, for coming out. My name, like Bobby said, is Cullen Pope. This is my partner, Zach Smith. Like Bobby had said, we represent Hilliard Lyons. Tonight, we're going to cover some of the basics of investing, along with some of the fundamental investment concepts. And then we'll kind of go over some investment options that you have, as well as a few different investment strategies. In the end, we hope that this overview will assist you in thinking about your own investment needs and whether or not you may benefit from working with a financial professional like myself and Zach. So to begin, I'm going to start by asking you to think about what investing means to you. Some of you may associate investing with speculation, maybe gambling on stocks or the volatility of the market. Others may see investing as more of a long-term, methodical effort to save for your future. And in fact, investing is a little bit of both. All investing involves a certain amount of risk, including potential loss of principal, and there can be no ironclad guarantee that any investing strategy will be successful. Investing involves the potential of growth of your money over time. Consider investing a carefully planned and prepared approach to managing and accumulating money. Investment planning is about discipline and patience, but it doesn't have to be difficult.
So let's talk about some fundamentals of investing, and we'll start here. This is going to be our starting point. Let's talk about inflation. So right now, if you think about inflation, inflation is really historically low. But if we go back to 1914 through right now, historically inflation is usually around 3%. Okay, so we're lower than that right now. Let's think about this scenario. At an annual inflation rate of 3%, if you have $100 right now, something that costs $100 today, in 20 years, due to that inflation, 3%, it's going to cost about $181. Okay, so you can see as time goes on, inflation is something that is key in thinking about your strategy for investments. And as we get into different investment options and talk about that, you'll see where that inflation kind of comes into play. So let's look at a scenario. Let's say you have $200,000 right now stashed in your mattress. And if you do, don't raise your hand or tell anybody that you do. But a lot of times, Cullen and I, hear people say, well, I'd rather just take this money and put it in my mattress or bury it in the backyard because it'll do better than if I invest in the market or some sort of investment. But that $200,000 that's stuffed in your mattress, same inflation rate, 3%. In 20 years, it's going to buy you about $108,759 worth of goods. So in reality, your purchasing power, the value of your dollar that you're going to purchase in 20 years, you see how that has decreased because we're not keeping up with even the pace of inflation. And pushing that a little bit further, in 40 years, less than $60,000. So that $200,000 we got in the mattress is going to buy us less than $60,000. Why is that important? Because if your investments aren't keeping pace with just inflation, in reality, you're losing money because the value of your dollar isn't worth the same as it was when you started out. So that's kind of the one of the first foundation fundamentals is just talking about inflation. And a lot of times people don't even think about what effect that has on their money and their investment plan.
Okay, so now I'll talk a little bit about the effects of compounding. Zach just touched on inflation. Well, compounding has the exact opposite effect of inflation. You know, with compounding, you actually earn interest on your interest. So let's say you invest $5,000 a year for 30 years. After 30 years, you'll have invested a total of $150,000. So, yet assuming your funds grow exactly at 6% a year, due to compounding, after 30 years, that $150,000 would grow to $395,000. All right, so now I'm going to talk about the rule of 72. Some of you may or may not have heard about it, but it's just a quick way to help you estimate how long it will take for your investment to double. So what you'll do is you'll divide the number 72 by the rate at which your investments grow, and that the result is the number of years that it will take for your money to double. For example, if the expected annual return on your investments is 3%, it should take about 24 years for your money to double.
So we've talked about inflation, we've talked about compounding. What about the fact of, well, really investing, sooner is better than later? You'll hear everyone talk about the time to start investing was yesterday, because the sooner you can get your money to work for you, obviously, the longer you have for that money to grow, whether that's in the market or different types of investing. And so the key is here is just not putting it off. And everybody's situation is different as far as what they can invest, whether it's in their 401k, IRA, or other investments. But you need the sooner the better for that potential for growth. And waiting too long can actually make it difficult to kind of catch up. And you're playing that catch-up game. So let's look at another example. Let's say you invest $3,000 annually at the end of each year, starting at age 20, okay? Let's assume a 6% growth rate, which with different types of growth-oriented investments, that's a fair number. 6% is actually a fair number. By the time that you are 66 years old, that investment that you did would have turned into about $680,000, okay? But if we waited till we were 35, playing that catch-up game, there's the $680,000. If we waited till we're 35, we did the same thing, invested the same amount of money, same growth rate that we're talking about. Now, we're not talking about what the tax implications are here. Let's just look at this just bare example. We go from that 680 to about 254,000. You can see that difference. We've waited 15 years, and so it's harder to catch up with the same amount of investment, the same amount of growth rate. And then if we take it one step further, and we waited till we were 45 to start doing that same investment plan, at 66, we would only have probably grown that money to about $120,000. And so you can see the power of the time that you have implementing that investment plan that's specific to you, the difference in the growth potential there, just looking 15 years, 20 years difference. Big difference there. So in reality, sooner is better than later. Now, if you're sitting there and thinking, well, I haven't, really done anything, no need to panic, but now's the time to kind of rethink about things, get a plan in place, and start catching up for the years that you've missed out on the opportunities for the growth.
All right, now I'm going to talk about identifying your goals and kind of different time horizons with those goals. And this is really just the first step in any investment plan. I mean, what are you investing for? Most of us accumulate funds for retirement or for a child's college tuition. Others, they invest for short-term goals such as down payment on a house or buying a new car. And others, they save to build a fund for any unexpected, any unanticipated financial need. So kind of like a rainy day fund, if you will. Yeah. And So if you've got multiple goals, kind of think about how you would prioritize them. And once you've identified and prioritized your investment goals, kind of consider the time horizon associated with each goal. Generally speaking, all else being equal, the longer your time horizon, the more aggressively you can and will be willing to invest. And that's saying that investments that carry more risk will tend to be more appropriate for those with a longer time horizon. And you might ask yourself why. The longer the investment horizon, the more time you'll have to recover any investment losses.
So let's talk about risk tolerance, okay? If I went around the room right now and asked, everyone, what would you say your risk tolerance is? We would probably get a different answer for each person because your personal risk tolerance is unique to basically your specific situation, family situation, if you have kids, if you don't have kids, later in career, just starting out. Everyone is in a different place, in a different unique spot. But when we look at risk tolerance, it really comes down to two different aspects. The flexibility that you have in your investment plan. So if you have more flexibility, longer time horizon, if you're able to put more money in, the flexibility of it, if you've got more flexibility, then you probably can take a little more risk because you can absorb those, any losses that we might have. The market, if you watch from day to day, you'll see, it's up 200 points one day, maybe down 300 points one day. If we look back historically from 2008 to now, the S&P 500 is plus almost 300%. We've been in a bull market. At some point, we'll probably see some sort of correction, but those are all things that kind of go in. So that first aspect is, what is your flexibility of your investment plan? What losses could you absorb? Is that 10%, 20% downturn? The second aspect is more the emotional aspect. Investing is a very emotional thing. Money, when it comes to money, you always hear people say, you see a different side of people when it comes to dealing with their money, and that's because money is a very emotional thing. And so your risk tolerance is driven on those emotions because a lot of times we'll sit down with people and when we're doing out a financial plan and say, okay, if the market dropped 20%, how would that make you feel? Well, if you couldn't sleep at night, you're worried to death, you're calling, hey, we need to get out of the market, then you're probably being a little too aggressive. If you can say, I'm okay with that, I actually would probably, if the market drops like that, I'll take advantage of that opportunity and I'll, maybe purchase some more shares because I can get them at a lower cost right now. You probably have a higher risk tolerance. But it all boils down to, we usually categorize those as aggressive, the ability, you're willing to take on more risk. Moderate, some risk is okay, but we want to stay in the realm of not being too aggressive. And then conservative is obviously that you're risk averse, and the plan that you want to put in place wants to be, to minimize losses and risk as much as possible. And it's very important, when you're putting together, your investment plan is to know what your, risk tolerance is, because that all plays into the investment options that, we put forward for you.
So while we're on the topic of risk, let's talk about the relationship between risk and return. And when it comes to investing, there is a direct relationship with risk and return. That is, in general, as the potential for return increases, so does your level of risk, and vice versa. So let's look at an example. If you're going to put your money into a bank CD, you may have very little risk, but in return, you're going to be offered very little in return. So the more aggressive you are as an investor, the more risk you should be willing to take. And more risk means a greater potential for return. Conversely, the more conservative you are, the less risk you're generally comfortable with, and less risk means less return. The key here is to try to maximize returns at a level of risk that you yourself are comfortable with.
Yeah, and as it says, down there at the bottom of the slide there, it's a risk-return trade-off. It's a trade-off. The risk you're willing to take is, a trade-off on the opportunity for return. So let's get into some different types of investment options. We've kind of laid the foundation for the fundamentals, talking about inflation, compounding, risk tolerance, time horizon. So let's start to dive into some things. So some of the types of investments that we'll cover, kind of an overview. Cash alternatives, we've kind of already touched on that. CDs, things like that. Bonds, stocks, some other type investments that are a little more complicated that we'll name them, but we probably won't get into a lot of discussion on them. And then funds, inherently mutual funds, exchange traded funds. But before we do that, a lot of times, Cullen and I, in our experience, we'll be talking to someone and there's a common misconception. And they'll say, well, I want to invest in a 401k or I want to invest in an IRA. Those are not investments. Those are simply the vehicles, okay? Think of those as like a bucket, okay? Your 401k is a bucket. Your IRA, individual retirement account, that's a bucket, whether that's traditional or Roth, two different tax ways of going. Even maybe a college savings plan if you've got kids. 529 college savings plans are strategies that we use for tax advantage ways for you to put money away for college. All of those things are the vehicle or the bucket. The individual investments like bonds, stocks, funds, those are the actual investments that we put inside the car or the bucket, the 401k, the IRA, the 529s. Those are the true investments. And those are all make up, that 401k account that you have or that IRA that you have. But a lot of times people misconstrue that a 401k is an investment, an actual investment type, or an IRA is an investment type. Those are just simply the vehicles that we use.
All right, now for cash alternatives, this is fairly simple. They're relatively low risk investments. They're short term, and they're generally fairly liquid. And what do I mean by liquid? In other words, you can convert them to cash very easily and quickly. You might use cash alternatives to provide you with relative stability, maintain a steady source of cash for emergencies or other purposes, or to serve as a temporary parking place until we can decide where to put that money. A few examples of cash alternatives include corporate CDs or money market deposit accounts, money market mutual funds, and U.S. Treasury bills. Some of the advantages of investing in cash alternatives, like I said, you receive reliable, predictable earnings, and they're easily tapped source of funds, so they're very liquid. The big trade-off here, though, is that the return you'll receive is very low compared to potential return offered by other investments. In fact, the problem with cash alternatives is they sometimes have problems keeping up with inflation. And like Zach said earlier, if your investments aren't keeping up with inflation, there's a good chance that you're losing money.
Yeah, and if anybody has, CDs or savings accounts right now, that a 5-year CD is paying less than 3%, and if we look at inflation, so, you kind of got an idea on those. Second type, bonds. And just keep in mind as we go through this, each of these types of investments have a place, and sometimes a mixture of all of them do when we get into kind of the asset allocation. But, high level, low on bonds, they're debt instruments. There's different types of bonds that there are, whether that be government bonds, corporate bonds that are issued by different corporations, municipalities, whether that be state, local, or county, state, different types. One reason that people buy bonds is because they usually will pay a fixed interest rate. Some are fixed, some are floated. But they use that for a source of income. Most of the time, those bonds are going to pay, twice a year, so semi-annually every 6 months. and may have a fixed coupon. Maybe like a municipal bond, some of those may have a maturity date of 20 or 30 years. Now, that doesn't mean that you're going to have that bond for 20 or 30 years. It could be called in early, but they have different fixed, whether it might be a fixed coupon of 5%. So that's the interest that it's paying you, and they can always be traded like other securities. So let's say you had invested in a corporate bond of let's say Apple. Apple issues corporate bonds. You'd invested in a corporate bond. You decide that you need to sell that. You can sell that. We'll go to the market. We'll get bids for it, and we can sell those. Just know that bonds are obviously, and we'll talk about this in a second. They're interest rates have a effect on bonds, and what interest rates are doing can affect the value of that bond when if we need to try to go to sell it. And just like I said, value can actually fluctuate. We've talked about a couple of the different types of bonds there. U.S. government securities, those are going to be backed by the full faith, of the U.S. government. Agency bonds, municipal bonds. A lot of times municipal bonds are bought for their tax advantages. Yes, ma'am.
My daughter got some savings bonds that
Okay.
was like awards, and I don't even know, what is that? What do you do with it?
Yeah, so a lot of times on those savings bonds, you can go to a local bank and they can tell you what the value is of those because they can run those. A lot of times they're Series EE bonds, EE. Yeah, and so a lot of I had some when I was growing up, and you can go and they can actually run the values for you, and then if you want to redeem them, and you can.
So does the value increase? Does it have increase?
It does, yeah. But those savings bonds, don't expect that they're going to have increased by a lot. It'll probably be very minimal. But yeah, they should have increased. But how long has she had them? For quite some time.
Oh, maybe 5 years.
Yeah. So they've probably increased some. But like I said, you can take them and they actually can run them and tell you, what the value of them should be and everything, and that you can redeem them there. Then obviously corporate bonds. So some of the advantages, obviously, and disadvantages of bonds. A steady and predictable stream of income because they're paying those coupons semi-annually. Typically, that income is going to be higher than if you had a CD and you were drawing the interest off of it on a monthly basis or some of them quarterly or annually. But typically, they're going to be higher than that. They're going to be, now to keep everything relative, they're going to be lower risk than stock type investments. So they're still seen as a lower risk. They have a low correlation to the stock market, but like I was talking about from an interest rate standpoint, if interest rates start to rise and you've got a bond, and that interest rate that you have on that bond is lower than what current interest rates are, then the value of your bond is probably going to have decreased, okay? Because now your bond's worth less than what the market's selling at. Now, on the inverse of that, if interest rates start to go down, and we always hear everything on the news about interest rates going up, but we all know that actually incrementally they're going up slowly, and you're probably seeing your loan, if you have any loans, loan rates are actually the ones that are starting to rise up. It's not our deposit rates like CDs and savings accounts that are really going up that much. But if interest rates started to come down, then the bonds that we have, if they're at a higher interest rate than what current are, they're going to be worth more, and that might be an opportunity for you to either keep those because you're earning higher or to get rid of them. And always with bonds, since they are a debt instrument of these corporations, could be high yield bonds, but you have the opportunity that corporation defaults on them, and that's where you can see some loss in value.
All right, so Zach just talked about bonds. I'll cover stocks a little bit. So when you buy company stock, you're actually purchasing a share of ownership in that business. Investors who purchase stock are known as stockholders or shareholders. The percentage of ownership in a company also represents your share of the risk and profits generated by that company. Beyond that, depending on the company and the types of shares you have, stock ownership may carry other benefits. Specifically, you may be entitled to dividend payments, which are generally received in either cash or additional shares, capital gains payouts, and other corporate privileges. If you purchase stock, you can make money in one of two ways. First is corporate earnings, which may be distributed in the form of dividends, like I just previously said. And secondly, you can sell your shares. If the value of the company's stock is increased, since you had purchased it, you will make a profit. Of course, if the share price is lower, you're obviously going to take a loss. There are two different types of stock that companies issue. One is the common stock, which hold many rights, such as you're able to vote at shareholder meetings. However, they are the last in line when it comes to claim of earnings and assets of the company. The second is a preferred stock, which is given priority over the common shareholders. Stock is commonly categorized by the market value of the company that issues the stock. For example, large cap stocks describe shares issued by the largest corporations. Others include small cap, mid cap, and micro cap. Stock is also commonly classified according to the characteristics of the company and the expectations for investors. Some examples of those are growth, value, income, and blue chip stocks. Some of the advantages, historically, stocks have provided the highest long-term total returns. You get the ownership rights. You can provide income through the dividends as well as capital appreciation. And they're fairly easy to buy and sell. I mean, when anybody thinks of the market, usually they think of common stock. Some of the disadvantages, poor company performance affects your dividends and the value of the share, which that happens on a day-to-day basis. They're subject to market volatility. You're greater risk. It's a greater risk to your principal. So when you invest in the market, you're going to put your money at more of a risk if you buy stock as opposed to a bond or a CD. Yeah. And it may not be appropriate for the short-term investor.
Like I said, the core of investments really is in that cash alternatives, bonds, stocks. Those are really the core, and we kind of branch off from there. Some other types of investments that you may have heard of or been familiar with, and I'm just going to name them. We're not going to go into them. If it's something that you're interested in, definitely, we left our cards here. Definitely pick up our cards. We'd love to have a conversation with you. But they're a little bit more complicated. Real estate, whether that's commercial or residential, and not necessarily going out and buying, a rental house or something like that, but real estate investment trusts, which are like funds that invest in a series of, there's a lot of healthcare ones, so they invest in hospitals or long-term care facilities, things like that. Stock options, so option trading, futures and commodities, and then collectibles, and collectibles would be more antiques, art, those types of things. And so those are kind of a larger branch off from just our core of cash and cash alternatives and bonds and stocks.
All right, so I'll go into mutual funds. Mutual funds are obviously another way to invest in stocks, bonds, or cash alternatives. It's quite simple. Your money is pooled together with other investors' money into one fund, which then invests in certain securities according to a stated investment objective. This fund is managed by a fund manager who reports to a board of directors. By investing in a fund, you own a piece of the total portfolio. So in these mutual funds, you can own up to a few dozen stocks, up to 100?
Oh yeah,
several hundred.
Yeah, maybe some funds I've seen. They may have 500 different pieces inside that portfolio.
And the thing about mutual funds is they provide you with both a convenient way to obtain professional money management as well as instant diversification, since you're going to be holding more than just one stock or one bond.
Just kind of a thing here about mutual funds, and also when we talk about exchange traded funds, every fund has a prospectus that you get if you purchase that fund or before you purchase that fund. It kind of goes into the fund managers, the internal operating expenses, things of that nature. We always recommend that we go over that, but you also read it too. And it's always, anytime you buy a fund, that should be made available to you. So a perspective for that. It kind of gives you a better idea of exactly what that fund is holding. So when we talk about different types of mutual funds, as Cullen said, it's an easy way to get good diversification, maybe with just a couple different funds. And we've talked about those three, keep coming back to those three major categories of cash alternatives, bonds, and stocks. And so you may see mutual funds that are, if they're cash mutual funds, cash alternatives, that's money market mutual funds, maybe called that. Bond funds, maybe surprising, but usually they're called bond funds. Some sort of, whether it's intermediate term, long term, but they'll be called bond funds. And then, of course, stock funds. Anybody take a guess what they usually call them? Usually stock funds. And so there are some, it's not, kind of one size fits all. There's all different variations of funds. A lot of times we'll see, especially folks that are starting to get closer to retirement age and things like that, or they may have a lower risk tolerance. They want what's called a balanced fund. A balanced fund, kind of just as the name says, it is a balance between bonds, cash alternatives, and stocks. Maybe like a lot of those balanced funds right now are probably sitting closer to like a 60% stocks, 40% bond and alternatives and things of that nature. But you don't just have to say, I just want a bond and a stock fund. There's different variations of those, and even can get into the large cap, mid cap, small cap. And it's good to have a broad, paint with a broad brush to have some exposure to large cap, mid cap, small cap, because all those companies, they're like gears. They all kind of work differently. And then also, right now where we're seeing, some opportunity is internationally. So there's some international funds. You can get into international bond funds, stock, different types of international funds, but those are going to invest in companies that operating outside of the United States. And something that has probably come on in the past few years is, active funds versus passive funds. Okay, actively managed funds, those fund managers, they're going to be looking for opportunities to buy and sell companies inside the fund. So inherently, the name actively managed, they're actively doing management. Whereas opposed to and they're trying to beat some sort of benchmark. Passive funds, those funds, a passive investor is not an investor that's being active. A passive fund is not really being very active. They're really trying to mirror an index. So index funds have become very popular with folks. Maybe the S&P 500 index, the 500 largest companies. Maybe even the Russell index, which is some smaller, the Russell 2000 or 3000 funds. And the objective of those funds are to really mimic that index that it's performing to. It's just trying to basically mimic what that index is doing, and so it's looking at those companies that make up that index.
All right, so to kind of hit on some of the advantages and disadvantages of mutual funds, like we've said several times, you get instant diversification, instant professional management. They relatively take small amounts to invest into a mutual fund, and they're fairly liquid. On the other hand, mutual funds are not a guaranteed investment. The value of the shares can fluctuate daily. A portion of your fund dollars may be tied up in cash. There's a potential tax inefficiency, and mutual fund usually have a fee or an expense which is taken out yearly, quarterly. They just vary from mutual fund to mutual fund.
I'm sorry, will you go back?
Yes, absolutely.
Well, what does that mean, potential tax inefficiency?
Really what that means, so with mutual funds, a lot of times they may kick out capital gains, okay? And if they do, then obviously you're responsible for that capital gain. And from the tendency of an active fund, if they're actively making movements and trades,
yeah.
then there could be some taxable liability to you based upon the cost basis and everything that they had, whether it's gains or losses inside the fund. So that point really goes into when we talk about exchange traded funds or ETFs. Usually they're probably a little bit more tax efficient for you because they're not making a lot of those movements. And so sometimes we'll use those for tax efficiency reasons, especially let's keep in mind, when we talk about investing, we've got two different really buckets of money. We've got non-qualified money, okay, which is like your just a regular investment account, individual account, and you've got your qualified money, which is your 401k, IRA, those types of things. The taxes are different on those different types of accounts. On a non-qualified account, you're going to get 1099s for that every year, where on that qualified account, until you take that money out, you're not going to have tax liability from that. So does that answer your question? So exchange traded funds are very similar to mutual funds. A lot of times, though, and there's a key difference we'll talk about, but a lot of times those, obviously ETFs, they're going to be based upon an index like we were talking about. It may be an index fund of the S&P 500. Passive management, so they're not making a lot of movement, so usually they're management fees that the funds actually pass on to the investor. Usually they're going to be lower than a mutual fund may be. And then the key difference between exchange traded funds and mutual funds is if you have ETFs, exchange traded funds, you can trade those throughout the day. You can buy them, you can sell them. If you called Cullen and said, hey, I've got this iShares S&P 500 fund, I want to sell it, he could do it right then as long as it's before 3 o'clock when the market closes, or you want to buy something. With a mutual fund, they trade at the end of the day. So you cannot buy, you can put in an order, but it will not execute until the end of the trading day. So it will execute at market close. You can't buy those, throughout the day. So that's a real key difference. And then back to the tax, it may be more efficient because they're being passive management and not making as many movements. Same thing with ETFs, the same thing you saw in mutual funds. They'll come with a prospectus, and so it's always good to look over that, when you're making those investment choices, whether doing it on your own or working with a professional.
I have a question.
Yes, ma'am.
So, like my 401k, they gave me a choice of different things. One was like, retired in 2040 or
Yeah.
2050,
Uh-huh.
2030. And so, is that a mutual fund?
Yes, more than likely.
Could be, yeah. More than likely, it's either a mutual fund or it could be an exchange-traded fund. Those are what's called target date funds, and so like a 2020 or a 2030. With those, the reason there's a date there, that's making a guesstimate that you're going to retire within about a 5 to 7 window, whether that's 5 years earlier than that or 5 years later than that. And so what those do is it kind of just puts everybody in that kind of strategy. And what they're supposed to be built to do is as you get closer to that retirement age, your risk, they're going to start being less aggressive.
Yeah, so real early on, you'll be mainly stocks, aggressive investments, and then by the time you're, 2030?
Yeah.
Is that what you said?
I
Oh.
think it was like 20.
Yeah.
Well, by the end of it, you'll be mainly just cash and bonds. So,
Yeah, and we see a lot of clients that have 401ks, and the thing is, 401ks are great, and we do 401ks for different businesses. Issue sometimes is, and it's not your fault or our fault, but it's kind of the rules that they've made is you can't get a lot of guidance on, what should I do? They gave me all these choices, but I don't really know what that means. And so a lot of people, they just maybe go into the default option. But we work with clients, and we can, look at those things and kind of give you some direction. We can't say exactly what you should do, but give you some sort of direction on those.
Okay, so we've kind of covered some of the fundamentals of investing, different investment options. We'll kind of hit on a few investment methods real quick. The first is dollar cost averaging. If you're currently putting money into a retirement account or a 401k, you are already doing this. With dollar cost averaging, rather than investing a lump sum, you're putting money in, smaller amounts in, over a period of time, no matter how the market is performing. So if it's down, you're going to put money in. If it's up, you're still putting money in. Your goal here is to reduce overall volatility of your portfolio by purchasing more shares when the market is down and less shares when the market is up. Although this can't guarantee you profit or avoid a loss, a regular fixed dollar investment may result in a lower average price per share over time, assuming you continue to invest. So let's do an example. Let's say you decide to invest $300 each month toward your child's college tuition. Because you invest the same amount each month, you automatically buy more shares when the price is low and fewer shares when the price is high. Over time, you'll find that your average cost per share is actually less than the average market price per share over the time that you invested.
So we've talked about a method of investing, dollar cost averaging. And this kind of goes back to, kind of looking at putting a plan together, asset allocation. And there's some different considerations that you have to make when it comes to, asset allocation. And we feel a portfolio should contain, various type of investments. So you have various different types of risk and in various sectors. And because of that asset allocation, it helps to kind of minimize that risk. So diversification, obviously that, looking at diversifying your portfolio, looking at your risk tolerance. And like I said earlier, every person is unique to whatever their risk tolerance is, what their time horizon is, what their goals are. And that's where we've got to start. We've got to start with those questions before you even kind of get into formulating a plan, because we you need to know that, like Cullen said, if you've got a short time horizon and a short time frame, it's probably not the best idea to maybe put all your money in the market, because if the market takes a swing, overnight and the market goes down, 20, 30%, and you needed that money for a specific goal, we probably got a big issue, because now overnight your accounts drop, 20 or 30% because you might have been being more aggressive, and that wasn't appropriate to really what your whole asset allocation and your time horizon should have been. And then, your liquidity needs. If you say, hey, I need this money relatively liquid and 5 to 7 years or 10 years, that all goes into play in the different investment options that we look at. And overall, asset allocation, it may be, different models. It may be a more aggressive model. It may be because you're younger and you've got more time on your side, or it may be more moderate because, hey, we're 10 years away from retirement and we've made some good money, because we've been working for 20 years. Let's kind of pull the lever back a little bit. We want to stay invested, but we've got different goals now because we're nearing into retirement. We're going to need that money for income, and so those all play into that, and figuring out what mix is right for you. And people, I've met with people that say I can do this on my own, and even folks that are retired, and that is certainly obviously your decision and your choice. But I always ask them the question, especially a retiree, that says, I'm just going to kind of do this thing on my own. Did you retire to take on a second job, or did you retire so that you've worked hard all your life, you want to enjoy retirement, do things, spend time with family, travel, different things that you want to do, and really doing your own is kind of taking on a second career. And so a lot of times it's better to work with an advisor, professional such as Cullen or myself, because we're doing this on a day in and day out basis. And when we were talking about our different risk tolerance, emotional, okay. Well, when you're doing it on your own, you've got a very emotional attachment to it. And as a client of ours, we've got an emotional attachment to you too. But we can kind of see things over the trees a little bit more. We've got access to, research materials and things that regular folks just don't have. We've got analysts and different things like that. So, kind of putting everything full circle. And these are just kind of some different models that you would look, different asset allocation models. And this is kind of exactly what I just said. Kind of the role of a professional is, helping you, sit down with you. We have a process that we call the Envision process, and it's a financial planning process, and that's where we start. And we ask you the questions about, what are your goals? Where are you at currently? Are you saving anything? Do you have any investments? How much longer do you plan to retire? Health, risk tolerance, all those different things go into kind of formulating that plan, creating an asset allocation model for you, selecting those specific investments that fit into those things that you said, and then managing and monitoring, your portfolio and continuously working with you, for the rest of your life is our plan is to work with you for the rest of your life. And then, if you've got kids or a wife or husband, to continue working with them, because when we take on a relationship, our goal is long term. Our goal is to work with someone and be there with you every step of the way, of your career, whether it's starting out, kind of midway through, or, getting to retire. That's one of the most enjoyable things that we get to experience with clients is they do get to retire, because nobody wants to really work forever. You want to be able to retire, and you've got a plan, sooner rather than later for those things. So, Cullen?
Well, we just want to thank everybody for coming out tonight. You guys have been a wonderful audience, and I guess we can kind of open up the floor for some Q&A. Yeah.
I'm about 15 to 20 years away from retirement.
Okay.
At what point do you suggest that clients start looking at their allocations and maybe go toward more of a conservative approach?
Okay, so the question is, at what point throughout your working life should you look at your allocation that you currently have? And when should you kind of make adjustments?
Maybe switching towards being more conservative.
I would kind of look at that yearly almost.
Yeah, I think it's a thing, whether it's annually reviewing kind of where you're at and things like that. Specifically, probably as you're inching into the 10-year mark of going, hey, I've got 10 years left of working. I'm serious. In 10 years, I'm going to retire. That's when we would probably, maybe take a portion of the portfolio. We've got some great different avenues that we look at, and we start kind of dissecting it and taking some of it more conservative, but still leaving you some opportunities for growth based upon the market. But yeah,
that's also kind of the time where you sit down and you think, all right, how much am I going to want to spend when I retire? How much money do I need each year? And a lot of times we meet with people around that time, and they don't have enough money saved up. So that's usually around the time that we say, all right, we either need to bump up what we're currently saving, or we either continue or kind of dial down the current allocations.
Yeah, but it's always good. It kind of sets out a roadmap of, okay, when I retire, this is what I really think that I want to have on a monthly basis, or, this is what I need for income, and, I want to travel, I want to take 2 trips a year. All those things, we kind of put those in together, and with this Envision process, we can work. That's a working piece that continues on with you, in a really good place to kind of reflect back on, to kind of see where we are, measuring stick basically, to see where we're at.
What does Social Security fit into that? I mean, is there going to be Social Security? I I hear all these rumors.
So,
Oh, you won't have any Social Security.
so the question is, where does Social Security kind of play into this whole picture? I would say yes. I mean, Social Security is going to be around. Now, may it be reduced by the time we are taking Social Security? It's possible. I will take the opportunity, though, to plug in. We actually have a Social Security expert that works for Hilliard Lyons. He's in our home office, and we actually usually do, I don't know, anywhere between 2 to 4 seminars every single year. And basically, you come, and he'll go through kind of the whole Social Security process and everything. But we can actually run an individualized scenario for you based upon if you're already getting your projected Social Security statements and things of that nature. We can run a projection and look at the
optimal time to take Social Security. And a lot of times it'll be hold off until you're 70, but that's not always feasibly possible. So we'll come up with a few alternatives, and it's really just to kind of help you get the most bang for your buck.
So do they figure Social Security over your whole lifetime of earnings, or is it based on like the last few years that you worked?
Well, they're going to look at your higher earning years is what they're going to look at, and that's what they're going to base it on, based upon looking at that. But I would also I always caution people that Social Security was never meant, whether it goes whether it's reduced or it stays the same. Social Security was never meant to be your sole source of income during retirement.
It was supposed to just be a supplement.
Yeah. And so that's where, kind of working, you mentioned the 401k, kind of looking at that, and we look plus the Social Security, okay, and we see the assets we've got are plus Social Security. That's how we get to that whole kind of retirement income number. And so it all goes back to that first, it's so important to start saving so that we've got something to complement in that supplemental income of Social Security.
Does the core inflation rate exclude food and energy?
That the 3%.
The core, is it core, is the word core inflation or?
Yeah, so it's not like energy prices and food, the fluctuation of food prices.
Those are excluded from when you hear the core inflation?
Right.
What about energy or food?
Right, right.
What is the inflation rate for food and energy?
Well,
I guess it varies a lot. You see gas prices.
It does.
Yeah.
It does. Yeah. I mean, historically, we're in a lower. We've talked about gas and energy. I mean, historically, right now we're in the lower realm of that. Now, everybody probably remembers in here. Let's just go back 7 years or 10 years, and we were paying $4 a gallon, and so price of oil has come down, and so the inflation rate of that is lower. Now, of course, it's relative to where we are living, because food prices are different. If you take the food prices here based upon, go to Nashville, one of the biggest booming metropolitan areas in the United States right now. Real estate's on fire there, but the cost of living and food and things of that nature is higher there than. Mm-hmm. Anybody else have a question? Yes, sir.
Social Security, regardless when somebody takes it, is it, I guess in the terms of index for inflation? Does it keep pace with inflation periodically? They adjust what your payout is?
So the question is, does Social Security keep up with inflation?
To any extent?
Yeah, I mean, there's going to be a cost of living adjustment. Usually, should be in those numbers and reflected in there. So, yes, it should. What's that?
Most of those increases go to Medicare.
True. Yeah, that's exactly right. Yeah, and that's a whole nother topic that a whole other animal to tackle is healthcare cost, and that's something that even goes into looking at, okay, this is my Social Security, but people look at when they're thinking about retirement and say, well, I can't afford to retire because I'm not even going to be able to afford my health insurance, and so different ways to plan for that, and we plan for that. But yes, I mean, there should be inflationary adjustments into that. But just like you said, I mean, a lot of that goes to medical costs.
And I thought you had mentioned that whether a person takes their Social Security at 63 kind of vary for each person, or the different strategies? Because some people might think, well, I'll take it now because their situation is more immediate, or
I mean, ideally, if the longer you wait, the higher your benefit's going to be. But in some cases, just because you wait till 70 instead of taking it at 66 or 67, it's not always the best strategy.
And I'll tell you, some things that play into that is if you have a spouse, could be,
Do the math on it.
Yeah.
could be a spouse. And when we run those Social Security reports specifically to you, and we look at those numbers, it's going to run out. If you took it at 65, if you waited till 70, and let that continue to just kind of basically earn money, that your benefit's going to be higher. But a lot of times we see that's not the right plan for people, is because they need that supplemental income, so they need to go ahead and take it early. The perfect scenario, if you can wait, obviously that's usually going to be your highest payout from a monthly basis. But we'll look at it and say, okay, if we did that versus if we took it earlier versus if we did later, what's the difference overall that we're going to, what's the main difference? What's the net between those two? And sometimes it's not enough.
You get when you can draw the most, if you keep working, they keep paying that in every year, and your
Yep.
Social Security keeps going.
Exactly.
Yes,
Exactly.
once you hit that age.
So it keeps rolling, as you wait, and there can be different spousal strategies that you can implement as well too. So Social Security is every time that our Social Security expert comes down, we actually learn something new because it evolves, and there's so many different strategies that people can use, and it's usually specific to kind of their situation. Yes, sir.
Is there a specific dollar amount, given the fact you guys obviously see data, I guess, on a daily basis that we don't, but is there a specific dollar amount that, like, when you get to what I would consider retirement age, somewhere around 70-ish, so if I start at, 25, and I've worked my whole life, and I've done exactly what you say, I manage mutual funds, stocks, do all this stuff, I get to 70, and I got, let's just say, $1.5 million in assets, so to speak, how much can I draw? I know, depending on what kind of lifestyle I want to live, right?
Right.
And what I want to do, but given this general area, right, and how much cost of living is in our area, how much should an individual, I guess, try to achieve so that when they get there, you understand my question, I guess. So how do they know how much they can draw?
Yeah, so the question is, what's the optimal number that they can get to by retirement that, kind of need to shoot for to draw off of? The old number used to be $1 million. I mean, it used to be $1 million, and usually we're basing it that, you're drawing off, somewhere 4 to 6% is a good number percentage off of your total assets that you're drawing. But it all goes back to kind of talking about inflation and things like that. 25 to 70, $1 million now is not going to be the same today as it would be then, and so it's an ever-changing target. $1 million used to be the number, but it's probably quite a bit higher than that. I would say, and this would sound a lot.
We wouldn't know. We just kinda
I mean, it'd probably be
throwing
between 2.5
numbers
to
out,
4. Yeah.
Makes sense.
Yeah.
How are companies like yours rated? Are they rated
As far as the firm,
Yeah.
the Hilliard Lyons. Yeah, so I'll give you, I know we're running short on time, so I'll give you just a quick background on Hilliard Lyons. One of the oldest firms that in the investment industry, started back in 1854, sorry. And we're headquartered in Louisville, so it's a regional firm. And so, yeah, I mean, we're always consistently in the top tier as far as wealth management firms. So I hope that answers your question. Yeah.
I know there's several different companies.
Yeah. Thank you all. I know we're out of time.
If you have any questions, come see us afterwards. We'd love to talk to each and every one of you. So thank you. Y'all have a good night.